What if I told you there's a retailer that charges its customers before they even walk in the door, sells products with almost no profit margin, and yet is still a favorite stock of legends like Charlie Munger? We're talking about Costco Wholesale Corporation, ticker COST. Many look at Costco and just see a giant supermarket. The smart investor sees something different, a subscription business disguised as retail, with a wide economic moat that seems unbreakable. In today's video, we're going to do a complete deep dive into Costco's investment case. We'll analyze the unique business model and why it's so hard to copy, the financial fortress and exemplary capital allocation, the real risks versus the growth potential, and of course, the international expansion that could ensure growth for the next 2 decades. If you like deep analysis without the hype, go ahead and hit that like button and subscribe. Let's get to the numbers. The business model and strategy. To understand Costco, you need to understand one fundamental rule. Costco doesn't make money selling merchandise. It makes money selling access to merchandise. The strategy is based on a model of extreme discipline. The company makes most of its operating profit from membership fees. This allows it to sell products at prices very close to break even. Key points. 1. The loyalty wheel. Low prices drive volume. Volume drives bargaining power. Bargaining power drives even lower prices. This keeps renewal rates stellar, around 90% globally, and even higher in the United States and Canada. 2. Executive membership. These members pay more for the annual fee, but they earn cash back. They spend on average 3 times more than a basic member. This creates a predictable, very high margin revenue stream, almost 100% margin on the annual fee. 3. Limited SKUs, stock keeping units. While a Walmart or Target might have 100,000 items, Costco works with only about 4,000 SKUs. Why does this matter? Supply chain efficiency, massive buying power over suppliers, and fast inventory turnover, around 30 days compared to 40 to 60 days for competitors. And finally, an important observation. Costco has already gained strong acceptance in countries like South Korea, Japan, and Mexico. International sales exceed $38 billion. Competitive advantage. Morningstar classifies Costco as a company with a wide economic moat. But where does this moat come from? 1. Cost advantage. Nobody can operate as cheaply as Costco. Sales, general, and administrative (SG&A) expenses are only 9% of sales. At Walmart and Target, it's around 20%. This isn't magic, it's structure. No expensive advertising. Stores that are warehouses, no fancy decor. Cross-docking model. Product arrives and goes straight to sale, minimal handling. 2. The private label. Kirkland isn't just a cheap generic brand. It accounts for 33% of the company's sales. If Kirkland were a separate company, it would be one of the largest consumer goods companies in the world. It offers better margins for Costco and builds customer loyalty through quality. 3. The treasure hunt factor. The shopping experience is designed to be a treasure hunt. You go in for toilet paper and leave with a TV or a kayak. This creates an excitement that Amazon's cold e-commerce can't replicate. Financial strength. Many retailers go bankrupt due to too much debt. Costco is the opposite. It's a financial fortress. Balance sheet analysis. Conservative leverage. Debt to EBITDA ratio of 0.6 times. For comparison, Target is 2.3 times, and Walmart is 1.4 times. Net cash position. The company has more cash and short-term investments, approximately $14 billion, than debt, $10 billion. Interest. In many years, financial income, interest Costco earns on cash, exceeds interest expense on debt. In other words, the debt is essentially free. This strength allows Costco to navigate recessions without fear, fund its global expansion with its own cash, and even pay special dividends, which we'll talk about later. Bulls versus bears. No investment thesis is perfect. Let's look at both sides of the coin. What the bears say? Risks. 1. The digital threat. Costco only has 7% of sales online. Walmart and Amazon are much more advanced in omnichannel. Will Costco fall behind with younger generations who demand fast delivery? 2. Saturation and bureaucracy. Expanding in Europe is tough. Strict labor laws and urban zoning can prevent Costco from replicating the American model at the desired speed. 3. Renewal risk. If there's a brutal recession, will people still pay $60 or $120 just to get into the store? Although history shows they do, it's a monitored risk. What the bulls say, optimists. 1. International growth. Stores in South Korea and Taiwan are among the highest selling in the world. The model works outside the United States. 2. Protection against e-commerce. 2/3 of sales are food and groceries. Delivering 20-pound bags of rice or cases of water is logistically expensive. Costco's physical store model is defensive against Amazon in these categories. 3. Member upgrades. The continuous growth of executive membership increases margins without Costco needing to open new stores. Growth avenues. The international factor. Where will Costco find growth in the next 10 years? The answer is outside North America. In the United States, still growing, about 15 stores per year, but it's a mature market. Costco dominates 60% of the wholesale club market there. The Great Blue Ocean, international. Currently, international sales are $38 billion, double what they were a decade ago. Highlight: international ROIC, return on invested capital, has been increasing, average of 16%. Costco is allocating more capital to open stores in China, Japan, and Europe. Adaptation. Unlike other American retailers that failed abroad, remember Walmart in Germany or Brazil, Costco has succeeded in adapting its product mix while maintaining its strict business model. How does Costco treat its shareholders? Its capital allocation is rated as exemplary. 1. Reinvestment. The number one priority is opening new warehouses and renovating old ones. This is the best use of money, generating returns of nearly 25% on invested capital. 2. Regular dividends. Compound annual growth of 12.5% over the last decade. 3. The bonus, special dividends. Costco doesn't do large share buybacks because the stock is expensive with high multiples. Instead, when cash accumulates, it pays massive special dividends. There have been 5 huge payments since 2013, totaling an extra $44 per share. This shows management that doesn't waste money buying its own shares at the top, but instead returns the excess directly to the partners' pockets. Conclusion and verdict. To wrap up our thesis on Costco Wholesale, we are looking at a company with a wide economic moat, unmatched cost leadership, and a very strong brand, Kirkland. Its financial strength is like a bunker, with positive net cash. Future growth will come less from opening stores in the United States and more from international expansion and increased efficiency, more sales per member. Risks exist, especially with slow digital adoption, but Costco has proven that its physical experience and treasure hunt model is resilient. Costco is the kind of stock that rarely looks cheap on traditional multiples, but the quality of the business and the predictability of its cash flow justify a premium for many long-term investors. What about you? Do you think Costco remains the queen of retail, or will Amazon and Walmart erode that moat? Leave your opinion in the comments. If this video helped you understand the company, share it with your investment group. See you in the next video.